if the economy does soft land, which that's certainly what the majority believes, either soft landing or no landing, then it probably will continue. And one of the reasons why there's so much enthusiasm for the smaller companies is because there's a view that the economy is decelerating, going negative, but decelerating, which gives the Fed cover to start cutting interest rates. If we get 1 to 2 rate cuts between now and the end of the year, or maybe even the first of next year, that's going to be probably it. And that's really not going to do a whole lot for companies that are heavily indebted. I don't think it's going to do a whole lot for the housing market, which is looking really ugly here all of a sudden. And, we could talk about housing and maybe at some point, but it's certainly defied gravity, unlike other parts of real estate, which are really coming apart at the seams, particularly commercial real estate. So it's an odd time, and there's a lot of weird stuff going on out there. And, we were talking about offline that, this theme, there's the great rotation, but there's also what I call the great disconnect, which is this divergence between really pretty scary fundamentals societally and geopolitically. I don't think I've ever seen Americans as scared as they are right now. So many people I talk to are thinking about relocating to another country, or, they're making sure that they can, survive, with, whether it's preppers or their armaments. And it's a very divided country. It's also a heavily armed country, particularly on the right. I just tremble to think what would have happened if that shooter had been a little bit more accurate and Trump was assassinated, what his very, very loyal followers would have done in the wake of that. But that's just one of many things that are fundamentally wrong with the country. We've talked many times before about what I refer to as the 4F scenario, the federal fiscal funding fiasco. You probably saw this. The Congressional Budget Office just increased the deficit. We thought it was going to come in at 1.6 trillion, which is bad enough, but they pushed it up to 1.9 trillion, $400 billion increase. So we're basically going to have another year where we run a $2 trillion deficit. And that definitely tends to support the market and the economy near term. But from a long-term standpoint, it's horrible. It's just this weird clash of bad fundamentals and kind of market euphoria. Sorry. We actually put out a buy on small caps early November of last year, and they're up 25% or so. Now you said, well, the market is too. That's true, but the market, of course, has been almost totally driven by NVIDIA and a handful of other mega cap companies, mega cap tech mostly. And you haven't had that in the small caps. So the small caps done it kind of on its own. So I think that's a little bit more impressive. But at this point, I would suggest, and actually did, ironically, yesterday in our Making Hay Monday newsletter, that you should be taking some profits if you did buy small caps when they were really cheap. So I wouldn't be chasing this one. It's been such a big move. And if you look at it relative to NASDAQ, it's like 20%. So NASDAQ's down about 10, small caps are up about 10. I'm rounding a little bit, but it's a 20% delta. That's pretty huge, as somebody would say, that we have the orange swan. I just don't think you're going to get that many rate cuts near term. And when you do get a lot of rate cuts, which is more likely a 2025 event, that's probably going to be a response to bad economic news, that we could be looking at a recession. There are some very bright people like Danielle DiMartino Booth who believe we're already in a recession, and she's got some pretty strong arguments in her favor. I read the other people that like Vincent Delaware and Kevin Muir, who say, your countryman, Kevin Muir, that there's no way you can go into recession when you got $2 trillion deficits, and I'm sympathetic to that view. So it's very confusing in that regard. I can kind of go back and forth. Sometimes it looks like we are tipping into recession. Just as a footnote, we're very close to triggering the SOM rule, which is this unemployment increase. It's 3-month moving average versus the previous 12-month, 3-month moving average. If it increases a half a point, 50 basis points, then a recession happens every time. And it's right on the threshold of occurring. And of course, we've had the longest yield curve inversion. We've had, I don't know how many months now of negative leading economic indicators, with 1 month that's slightly turned up before turning to the downtrend. So it's like so many things we're dealing with in our world right now. Very, very confusing. But eventually we're going to have a recession, and then the Fed's going to cut like crazy. And people say, well, that's great. Well, not really. I mean, if you look historically, when the Fed has really been in a frantic rate cutting mode, markets have struggled. I mean, just look at 2000, 2003, and then over 2007 to early 2009. Those were times where the Fed was cutting, very, very quickly and deeply, and basically took short-term interest rates down close to zero. And yet the market went down cut in half, both cases. So this could be the classic, be careful what you wish for, you might get a good and hard. Yeah, I think that the tip-off is going to be the bond market. And perhaps a good example of that is what happened with Liz Truss in the UK 2 years ago, when she tried to do a very call it Trump-like budget, and the bond market just went into free fall. And I think that is a challenge we've got, is both of the two presidential candidates have shown absolutely no interest in any kind of fiscal rectitude. And I think especially Donald Trump is likely to really slam the pedal to the metal especially if he feels like there's a recession, and he could, of course, blame it on the prior administration. And that could happen. I mean, we could be looking at quasi-recession, maybe full-blown recession by the time the election happens. Maybe not. I mean, as I said earlier, it's very hard to determine that conclusively. Always is. But if it happens, I think the fiscal response from fiscal and monetary response from either party is likely to be extremely dangerous for the bond market, particularly the long end of the bond market. And the long end of the bond market is already struggling. There's the Treasury is issuing at the short end. In fact, they were just criticized by a couple. Maybe saw that paper in Nerol Rubini, and I forget who the other guy is accusing basically the Fed of gaming the bond market. I think they're just kind of doing a stealth Operation Twist, where they try to keep the long rates down and issue so much on the short end that the short rates stay high. So that's one reason why we got this tremendous and long-lasting yield curve inversion. And it's just at some point, I think the bond market's going to say no loss. The bond vigilantes rode a bit last year. In the third quarter, I think they're going to saddle up again. And you're going to see real stress in the bond market at the long end. Short end, there's huge amounts of demand, so they'll probably continue to skew very much towards the short end for new issuance. But you think about these $2 trillion deficits, and then all that has to be rolled over. It's something like $10 trillion in total needs to be raised between those bonds that are maturing and then the additional debt over the next year. It's just a staggering sum. And you've got foreign central banks that, as you know, are net sellers of U.S. Treasuries. The Fed is still a net seller through quantitative tightening. So you got two former huge buyers that are now sellers. So it puts a tremendous amount of pressure on retail investment banks. Are really not buyers of longer treasuries either, because they got so crushed with their longer treasury bonds. That's why 3 big bank failures happened last year. So I think that's off the radar of most people right now, is another bond market convulsion similar to what we had in the third quarter of last year. Well, I think total foreign ownership of U.S. Treasuries is around $7 trillion. I could be wrong about it, but they still own a lot. It's just that the trend has been down. The only countries where you're seeing aggressive buying of Treasuries are those like Luxembourg, which are basically conduits for hedge funds. So yeah, I think you're bringing up a great point. Is where is that going? And there is a school of thought that interest, called $1 trillion of interest payment, is stimulative, and I think to a certain extent it is, but it's stimulative to a very limited percentage of the population. And so it's this tale of two situation. And I think we've talked about before. You got a tale of two consumers and a tale of two corporations. So if you're a wealthy consumer or a cash-rich corporation, these high interest rates are manna from heaven. So that's very good. Now, but the trouble is those entities tend not to be big spenders, so that they tend to just reinvest, and that could be one reason why there's been this persistent bid under the stock market with this this interest rate windfall being recycled into other financial assets. Whereas if you're lower income or you're a more leveraged corporation, these higher interest rates are disastrous. As you know, there's over $1 trillion of credit card debt, and that's at a rate of, I think, 23%. It was the last I saw. It's a usurious interest rate on credit card debt. So it's the classic case, and really the last thing we need is a society right now where the rich get richer, the poor get poorer.